Welcome back. Okay. So we in chapter 9, we looked at what cash can do for us. Like what are the necessary things that we need to spend in order to be able to purchase things, have an emergency cash fund, so on and so forth, cash registers, business credit cards. Right? We saw what our business is going to be like. Now, what happens if we decide to take a look at receivables? What happened? Now we're switching on to the customer side standpoint, right? How do we generate that money for us to be able to spend the money? Well, first topic is going to be looking at receivables and what happens when you have the risk of using receivables. So, what are receivables? Once again, receivables is a means where you can allow your customers to pay you on an account, and by doing so, they are essentially taking the product and they're going to promise to pay you back another time. So, again, in this case, right, we treat accounts receivable as if it is an IOU or another form of payment. Okay, that we receive from our customers. Now, in this case, right, they, of course, with an IOU, there is a deadline or a due date. That means if they decide to purchase products and services from you, right, they have X amount of days that they have to pay you back. So that's the circumstances of having receivables. But there's a lot of risks when it comes to having receivables because, again, can you trust the customers that you are allowing to say, "Hey, I will give you an IOU. Okay? I will take the product now and I would give you an IOU and I'll promise to pay you back later." So that's a situation where you have to know that this is a very huge risk of doing business, is allowing your customers to owe you on an account. Okay? Because we can never know. We can't predict someone else's given financial situation, right? We don't know. They could lose their jobs the next day. They could be fired from their job the next day. They might not find you as a priority and might slack on their payments. There's many reasons why a customer can fail to pay what they owe you. So the idea here is, can you trust them? Now, of course, a credit score can be deemed as proof that a person can be trustworthy to owe you money and have the capabilities to pay you back. However, this is more geared towards your general customer, right? What's your demographics? Are you gearing towards low income family? Because if you are definitely taking a very huge risk for allowing those low income families to be able to buy stuff from you because they have a higher chance of not being able to pay it back. So that's a huge risk to having receivables in general for a business. Okay. So what happens when you do have those customers that do end up faulting on the payments? We call this the allowance for doubtful accounts. So let's say you do have people owe you on an account, right? What happens when that one day arrives and they fail to make a payment? So in this case, we must use the allowance for doubtful accounts account. All right, it can be seen as many different accounts. It could be allowances for bad debt or just bad debt allowances. In this case, it could be known as anything else, but for this class, I use allowance for doubtful accounts. It kind of gets the idea across. So this account is a contra account. Okay, it is a contra account to the accounts receivable account. This is a means because, again, when we have an account receivable, right, is it money that we received yet? No. If your customers owe you money that haven't paid you yet, so basically the money that you're racking up is going to be money that's being owed to you, but it's money that you have not yet received. So in this case, right, you're counting invisible money. So that's what a contra account does, is it reduces that invisible money because it's money that you haven't even received yet. So if a customer decides to fail to make a payment to you, at least you can create a contra account to help you reduce the accounts receivable account. Okay? So again, many reasons that a person can fail to pay a payment. Maybe they filed for bankruptcy. Maybe they just don't want to pay you anymore. They got fired from their job. They just don't have enough money to pay you. There's many reasons that a customer can fail to make a payment. Okay. So in this case, what are the criteria that you are going to be needing in order to use the allowance for doubtful accounts? Here they are. You're going to obviously know who didn't make a payment because you know who makes a payment and who doesn't, right? That's what we're going to be using the accounts receivable account for, is to keep track of who owes you and who doesn't owe you, and who has paid and who hasn't paid. So in this case, when a customer does fail to make a payment, you would know immediately who it is. Okay? And of course, you would know exactly how much they owe you, because if you're keeping a good track record of their payments, then you know exactly how much they owe you. So therefore, and of course, you know exactly when. When you notice that someone missed a payment on that date, you know exactly when. So those are the 3 criteria that you're going to be able to use the allowance for doubtful accounts, because you would not exactly know which customer owed you the money, how much they owed you, and when they decided to not pay that day. So then, let's go ahead and take a look at an example here. Okay, if on December 16, Mr. Sanchez buys $100 worth of toys, okay, on an account, and he pays $20 every month starting in January. Okay, so let's go ahead and record the first one, which is the actual sales itself. So we sold to him on December 16. He walked away with the $100 worth of toys, and we placed it on an account. So we got accounts receivable, and it was for $100. If he starts to make his payments slowly on January, then we're going to go ahead and record every single payment, right? So January 16, Mr. Sanchez makes a payment for $20, okay, with a check. So we're going to go ahead and record that he paid $20. So then that reduces the amount that he owes, right? So he now owes me $80 because he paid his first payment of $20, okay? Then on February 16, he also pays another $20. Okay, so then now we went from $80 to now to $60. Okay, so therefore, let's say now on March 20th, right, he missed his due date, and he decides to tell you that he decided to file for bankruptcy and can no longer make a payment. Well, in this case, he can no longer pay. Well, let's establish we know that he owes me $60. So how do I go ahead and write this off? In this case, you're not going to write it off yet, right? You're just going to transfer the amount. Think of the allowance for doubtful accounts as a temporary placeholder, right? Because in this case, we're removing his amount out from the accounts receivable so we don't have it affecting anybody else who does owe me money, right? And is still actively paying. We're going to place it into a temporary account called the allowance for doubtful accounts for the total amount that he can no longer pay. So in this case, he made 2 payments of $20 already for January and February. Now in March 20th, he can't pay because now he still owes me $60 on an account. So I'm going to go ahead and put this in a temporary account right there. Okay, that's all I'm doing. Okay, now that it's there right now, but that doesn't mean he can't pay you. He even though he filed for bankruptcy, he still can pay you technically. So in this case, he still has a possibility to pay you, but he's already paid $40 off of his actual total amount that he owed. So in this case, that's why it's called potential debt, or sometimes they have an account called potential bad debt, right? Allowance for doubtful accounts. So there you go. You transfer the $60 there. Now, of course, we talked about that he still has the possibility to pay. All right. So again, that's how you use the allowance for doubtful accounts is that you go through the motions, and then whenever they stop making a payment, then you can go ahead and be like, okay, you're gonna remove their amount from the accounts receivable and place it into the allowance for doubtful accounts. Okay. So then, what happens when bad debt arises? Okay, bad debt expense is when you are reaching at the end of your accounting year, and you need to realize that realistically, you are not going to collect 100% of the money that people owe you. Right? It's reality, right? We know someone's going to fault their payment. We know we have a few, depending on your demographics that you're gearing towards, right? Who are you allowing to be able to owe you on a credit card or on an account, right? So that's going to be what you're going to be relying on, is that you have to know that it is a risk. Now, for businesses, there is a threshold. The government allows you to take up to 5% losses. Up to 5% losses, okay, for the accounts receivable, okay? So that's just a fun fact. So, how do we understand what bad debt does? Well, like I mentioned, right, usually when we look at accounts receivable, right, if it becomes uncollectible, meaning we have exhausted as much time and effort to try to collect this debt, and it's been months and months, this bad debt becomes uncollectible, right? It becomes bad at that point, right? Because think about it. You have a customer who's been with you for how many years, and then they can't pay you, and you send them a bunch of letters, give them a bunch of phone calls, and you keep asking them to pay you back, and they're not budging. Then you're better off, instead of wasting all that time and energy, you're better off to just write that person off as a bad debt. Now, in this case, right, you use this uncollectible debt and it becomes a loss. Now, let's take a look at this situation, right? In this case, because we are making an estimated amount, right? Because Mr. Sanchez might be able to be one of those individuals that unfortunately becomes potential bad debt. But we have to also remember, the government allows us to to write off at least 5% of bad debt as a loss. Okay. So because in this case, right, because this is a estimated number, right, we can't really predict who is going to not pay and who can't pay, right? Because if everybody owes me money, right, my assumption is realistically, I'm not going to be receiving 100% of my money back. I'm at least going to get 95%. So that means I'm going to calculate that 5% potential bad debt that I know I will not be able to collect from all the people who owe me money. So that's the idea where this bad debt comes from. So that's why it's going to be considered an estimated number, right? It's an estimated number that you're going to be looking for future losses. Okay? So again, who? Do you know who? No, because you can't predict who's going to stop making a payment and who's going to make a payment. So in this case, you actually do not know who. All right? Maybe you know a few individuals, but that's about it. But you're not going to know everybody that isn't going to make a payment on their whoever you're going to not be able to know or predict who's not going to make a payment on time. So therefore, you will not know who. Now, the amount, in this case, of course, it's an estimated amount, but again, you're not going to be able to predict who can't pay you and who can, right? Because that's the thing about customers is, especially when you place them on an account and you give them some leeways into terms and payment plans, you're not going to be able to know how much a person is going to be able to pay or not. So for instance, right, maybe someone paid $15 instead of $20 because you allow that. So in this case, you're not going to be able to know exactly how much is going to be faulted. And of course, you're never going to know when, because anybody can fault on their payment at any given time. So in this case, when is a crucial number, because again, you may recognize that someone stopped paying, but maybe they forgot to make a payment, and then they said, "Oh, I'm so sorry, I'll pay you next month." They still end up paying you. So in this case, when they're going to be when your debt becomes completely uncollectible, you will never know, you won't be able to determine that exactly when. So that's the huge difference between using the allowance method and using the bad debt method. Okay? Now these are two different methods, because this one is going to be an adjustment entry, as you can see. This one is done usually typically at the end of the year, when you're making your year-end predictions and adjustments and things like that. Whereas the allowance method usually happens during the year, right? So as soon as you find out that a customer decides to not pay you, then you're going to record it as soon as you know. But in this case, right, this is an estimated amount of number, right? Because this is what you're predicting for the future, is that you're not realistically going to be collecting all 100%. So in this case, right, like I've mentioned, right, the government allows you to take up to 5% off losses. Okay? So in this case, this is going to be an estimated amount, and it's an adjustment entry, meaning it happens at the end of a specific time frame. So again, if it's the end of your accounting period, then you can do so. Okay? So again, in this case, to make it less confusing for you, the bad debt derives from the allowance for doubtful accounts. As you going through the years of collecting the money, and if you find someone that doesn't pay, then that's going to be considered an allowance, right? And eventually, when you reach the end to the conclusion where that person isn't going to make their payment at all, then you can go ahead and make your adjustment entry and include that person in your bad debt expense. So again, that's the huge difference. That's where it's deriving from. So again, there are two methods that you can use to write off bad debt off of your books. Okay, you have the direct write-off method, and then you have the allowance method. Okay, so the direct write-off method is generally used for tax purposes. Okay, and again, it is only used for the IRS. So in this case, you absolutely cannot be able to use the direct write-off method, because you guys are not tax accountants. You guys are the general ledger accountants. You guys are just regular accountants at this point. You're not a tax accountant. So in this case, you are unable to use this method, where literally you are taking the bad debt directly out from the accounts receivable. Okay? That is the direct write-off. But what you can do is the allowance method, which is governed by Acct, and it says that all accountants are able to use the allowance method. But the allowance method is broken down further into two ways that you can do. So you have to choose one or the other. You can't use both. So in this case, you got the balance sheet method and the income statement method. Okay? All right. So let's go ahead and dive right into what those methods are. So let's talk about the balance sheet method. If you choose to use the allowance method, or you are going to be doing the allowance method, if you choose to use the balance sheet method, what is the difference here? Okay, well, let's take a look at the scenario first, and then we'll analyze what you need to know. So right here, example says it is estimated that $25,000 of its $500,000 accounts receivable is to be uncollectible. Okay? And of course, there is currently a debit balance of $5,000 in the allowance for doubtful accounts. Journalize this transaction. Okay? Or journalize this adjustment. So once again, what are things that you need to identify? Well, in this case, let's just go ahead and do the basic building blocks of the journal. Since it's a bad debt expense, right? Expenses are increased by a debit, so that's going to go first. And this is where your allowance for doubtful accounts becomes a credit. Okay, therefore, hence it's a contra account. Okay, it's going to be credited at here for the allowance for doubtful accounts. Now again, we mentioned, right? How does a allowance for doubtful accounts have a debit balance? Well, what did we do in the very beginning of the scenario, right? We calculated for Mr. Sanchez's debt that he owes me, right? I had to debit my allowance for doubtful accounts for it to become a $60 balance. In this case, this is just everybody and everybody who owes me money. Right now, I currently have a $5,000 debit balance in my allowance for doubtful accounts. Okay, so that's where it's deriving from. Okay, so what are the key components I need to look at? Right here says I need to find three things. I need to identify the estimated amount. So in this case, I have 25,000. Okay, that's my estimated amount because it is out of 500,000. So again, 25,000 is my estimated amount. Okay, and then the next one is I need to look for this keyword accounts receivable. Okay, and then of course, and if I do see that, then I need to know, is there a balance in my allowance for doubtful accounts? Because that's going to tell me, do I need to debit my account or do I need to credit my account? Or I'm sorry, do I need to add to the number or do I need to subtract the number? So in this case, if there's a debit balance in my allowance for doubtful accounts, I need to add that account balance to my estimated amount. Okay? If I have a current credit balance in my allowance for doubtful accounts, then I need to subtract the $5,000 balance from my estimated amount. Now, why is that? Because we've already established this key rule here is that your allowance for doubtful accounts has a credit balance. The goal here is because the estimated amount is going to be your ending balance in your allowance for doubtful accounts. So if you currently have a debit balance there, you need to backtrack it and go all the way to get to the point where you're going to have that ending credit balance of 25,000. Okay? So why is this called the balance sheet method? Well, when we take a look at our balance sheet, right, it's a list of all of our assets, liabilities, and equity. So boom, you're definitely going to see the accounts receivable appear, as well as its contra account allowance for doubtful accounts. So hence the key word balance sheet. Okay. Now, of course, how do we figure the number out here? Okay, how do we figure the number out here, right? We've mentioned to you, right? You find those three things, right? The estimated amount number is 25,000. There's the word accounts receivable, and you have the word debit balance in your allowance for doubtful accounts. So because we need to get to $25,000 in your allowance for doubtful accounts, I currently have 5,000 in there. So because if you remember from what we talked about how debits and credits work, it's like a number line. If you're on the left 5,000, how do you get to the right? You're going to be adding, or in this case, you're going to be crediting the account for $30,000. Okay, so that's going to make your account balance go from left all the way to the right side. Okay. All right. So then let's take a look at the scenario number 2 then. What if I have the same exact scenario where I have an estimated amount of 25,000 and my out of 500,000 and its accounts receivable is to be uncollectible. But this time I have a credit balance of $5,000 in the allowance for doubtful accounts. How do I record this adjustment this time? Well, in this case, right, like I mentioned, if you're on a number line, you already have $5,000 in your credit balance right now. You're already on the right. How many more do you need to go in order to get to 25,000? So that's exactly what you need to do. So we know the estimated amount is 25,000. It's accounts receivable. Because I have a credit balance, I need to move to the right. How many more to get to 25,000? You only need 20,000 more. Okay? So that is how we use the balance sheet method. Any questions?
No.
So then let's talk about the income statement method, right? So this one differs slightly, okay? In this case, this one's a little more simpler, okay? So here's the scenario, okay? It's the same exact scenario as the previous one, okay? So this time you have an estimated amount of $25,000 of its $500,000 total credit sales, okay? Is to be uncollectible, okay? And there's currently a debit balance in the allowance for doubtful accounts for $5,000. Okay, so what are the key things that I'm going to be looking here for? Number one is the estimated amount, right? So in this case, 25,000, and the keyword total credit sales. Once I establish that the total credit sales is there, that means it doesn't matter what balance I have in the allowance for doubtful accounts. All I care about is the total credit sales. So in this case, I would just take the estimated amount of 25,000 and that's it. Okay? So, but why is it called the income statement this time? Well, because let's take a look at an income statement. You will never ever see accounts receivable or allowance for doubtful accounts. You will only see credit sales. Okay? So remember, your income statement is all of your sales minus all of your expenses. So in this case, you only see total credit sales. You do not see the accounts receivable or the allowance for doubtful accounts. So that's why you don't care about the allowance for doubtful accounts. So once again, that's all you need to do. You establish what the estimated amount is, find the keyword total credit sales, and boom, that's all you need to know. It's just the total credit sales. And that's the income statement method. Okay? So same situation. This time you have a credit balance of $5,000 in your allowance for doubtful accounts. So same situation, right? This time it's 25,000, estimated 25,000 of a 500,000 total credit sales. So in this case, we just look for the estimated amount of 25,000 and the keyword total credit sales, and that's all I need to do here. Okay? And you're going to write off your bad debt for 25,000 with your allowance for doubtful at 25,000. Okay? Any questions in regards to bad debt? Because here we are, chapter review, right? We learned about the allowance method, about having receivables, okay? So again, allowance method is usually done during the accounting period, where when something happens, when a customer fails to make it a payment, right? You'll know exactly when, you'll know exactly who, and you know exactly how much. So in this case, this number derives from all the amounts that are not being paid. Okay? Where your bad debt expense is an adjustment entry that happens at the end of the accounting period. So in this case, you don't know who, because you're making an estimated amount. You're estimating how much money you're not going to be collecting out of all the people that do owe you the money. So you won't know who, you won't know when these people will fault on their payment, and you don't know exactly how much, except for whatever threshold that you're going to be using. So in this case, if you're using 5%, then you know exactly 5%, but you don't actually really know, right? You don't know how many people are going to pay and how many are not going to pay. And of course, here are the two methods, right? You got the direct write-off method, which is not allowed to be used, but at least recognize that is a way that you can write off bad debt. And the allowance method, which is broken into two other methods, which is the balance sheet or the income statement method. So once again, We saw the difference between the balance sheet and the income statement, and this is what you have to journalize at the end between the two methods that you choose. You can only choose one. This is the journal entry, bad debt expense, and the allowance and credit the allowance for doubtful accounts. Okay. Any questions in regards to chapter 10.1 receivables?
No.
Okay, let's go ahead and finish up today with the exercises. So here we are. Question number 1. On December 15, Robert K. buys a total of 100 coffee mugs at $9.99 each on an account. Sales tax is 8.25%. Okay. So how do I record this? How do I record that I sold 100 coffee mugs for $9.99 each to Robert on an account?
Accounts receivable, debit, $999.
What about the sales tax?
Oh, okay. $42.42. 99. So 1,081.42. Oh no, wait, we're separating it. Okay, 999, and the sales tax is 82.42.
81.42.
82.42. I think is what I got.
Okay.
And that makes your total 1,081.42.
Okay. I'm going to take your word for it.
Okay.
All right. Okay. Number 2. So if on January 15, Robert sends a check for $25.
So it'd be checking, 25 debit. And
Okay.
then accounts receivable, 25
Yes.
credit.
Yep, because he's paying for a portion of what he owes for $25. Okay, and then of course I'm also gonna make a note here. I think I'm supposed to put a description there. Robert paid okay. Robert paid, and then this was supposed to be that we sold.
Oh yeah, I always forget the notes part.
Yep, sold 100 mugs to Robert. Okay. All right. All right. So then on February 15, Robert informs that he can no longer pay due to his financial circumstances.
So it'd be allowance for doubtful accounts.
Yep. So this is where we're going to transfer the money.
And so you would do, and he paid 25. Yeah.
Yep, 25.
So he still owes $1,056.42. Because you just put the amount left that he owes, right?
Correct. Yeah. Correct. Because we don't know when he's going to pay us back, right? We can't just say he's not going to pay me my $25. No, we don't know. Because again, anybody can pay above the minimum, or anybody can pay, well, not below the minimum, but you know what I mean, right? Especially when you're making kind of
Right.
payment plans, right? You can't predict what they're going to pay you, because today they could pay you $25, tomorrow they could pay you $100, and then the next day they could pay you $15. You don't know. That's the
Right.
dangers of having a payment plan like that, because you're never going to know what they're going to pay you, because one person might be like, I'm going to pay them all off. One person might be like, I'm just going to pay the minimum. So in this case, we can't predict that. So we have to get rid of the entire account balance, because we don't know what's going to happen. So,
Right.
good. All right. So where is this coming out from?
The accounts receivable.
Yes, from the amount that he actually owes me left remaining, because he's already made a payment already, right? So in this case, this is
Right.
how much he actually still owes me. So again, I'm going to go ahead and make a note, right, to say to remove Robert's account receivable balance. So A R is uh, a shortcut for accounts receivable. Okay. All right, number 4. So then on June 15, Robert says he can pay $25 this month and sends a check.
So now you would take it from the, what was it called? The allowance for doubtful accounts instead? Or you
Okay.
still take it from accounts receivable?
Well,
No.
well, how can you take it from the accounts receivable?
No, you
It's not
removed it
there.
from there. Yeah.
Exactly. Now, think of it this way. If someone decides to no longer pay, right? What do you normally do to them?
You close their account?
You usually freeze their account, right? That means they can no longer do any activity except for pay, right? So in
Okay.
this case, if I transferred them out because he already notified me that he's not going to make a payment. We don't know whether he's going to make a payment or not. So if I'm freezing his account, what do I have to do in order, like, because now that we received a payment, what do I have to do now? I would have to
Uh,
I would have to unfreeze his account, right?
oh, okay.
And make it active again. That's usually what happens, right? When someone doesn't pay, right? You immediately flag their account and make them inactive, because you don't want them to continue buying stuff when they can't pay, right?
Right.
So you would.
So you
Mhm.
move it back to accounts receivable?
Correct.
Okay.
Yes, you have to reactivate his account.
So that'd be
Be
debit 1,056.42. And then you'd have to do the allowance for doubtful accounts there. And that would be a credit.
So this is why you would normally have a credit balance in the allowance for doubtful accounts, because we're switching back and forth, right? Because in this case now, the person is now deciding to pay now. So that's why
Right.
I have a credit balance in my allowance for doubtful accounts. That's where the credit balance derives from as well. All right, when people can pay, when they told us they weren't, but they can pay. So in this case, yes, so you're going to transfer the 1056.42, and then now we can go ahead and record the payment.
Now it would be
Uh, okay, and then that will be, how do I record his payment?
the checking,
Because he sent me a check.
right, for 25 debit. And then accounts receivable 25 credit.
Just because now he's active again. That means he has potential to continue keep paying and paying and paying.
Okay.
All right, and then of course, Robert, or received. That's what I usually do. Received payment P from Robert. All right, now it's July 15th, and then Robert files for bankruptcy, and a bank a bank collector that informs you that he can no longer pay for the bill that he owes. Okay, so that means it's no longer collectible.
Okay. So now you would be moving it back to allowance for doubtful accounts.
Correct. We need to have that in the allowance for doubtful accounts. So in this case, allowance for doubtful. Okay, and where are you taking it out from?
The accounts receivable.
For this time, how much this time?
I think it's 1,056.42.
Minus, minus the
Minus
25.
25. 1,031.42.
Okay, and of course, to remove Robert's accounts receivable balance.
Okay.
Okay, so then let's see. So then now it is now December 31st, right? And your company estimates that $2,590.54 of a $29,475.72 accounts receivables are to be uncollectible, okay? Including Robert's debt, okay? And of course, you had a total credit balance of $157.62 in the allowance or double accounts. Remember, Robert's not the only one.
Right.
So how do I journalize this adjustment?
So
It's the end of the year.
would this be the bad debt expense?
Correct. It's the bad debt expense, right? Because we're making our adjustments. The end of the year. It's our estimated amount. This is what we're writing. We're actually writing off our books.
Okay.
Mm-hmm.
So, and then the amount would be the debit of the 2590.
Now, 2590, okay? So you found, okay, that's the estimated amount. Okay, so which method are we going to be using? Balance sheet or income statement?
Do you just get to pick one, or?
Well, in this case, there's a key word that you look for to tell
Oh, okay,
you.
that's right. Okay. Accounts receivable. So we're using balance sheet.
Correct. So if because we're using the balance sheet method, does the allowance for doubtful affect the estimated amount? Yes, it does. Okay, so in this case, I currently have a credit balance of $157.62 in the allowance for doubtful accounts.
So the allowance for doubtful accounts would go in the next line, and
Yes.
you would put the 157.62 in the credit column,
No.
in the debit column,
No.
because you're okay.
You're okay. So you already have $157.62 in your allowance for doubtful accounts. You already
Okay.
have it in there.
So this would be the 2590.
The 2590 is your end goal.
Oh, okay. So 29 is what you actually have. This part's confusing.
Okay, I need my end goal that I need to get into my allowance for doubtful accounts is the 2590, okay? But I
Okay. You want to get
currently
the 29 down to 2590. The 29,000 down to 2590? No.
okay.
Sorry.
Okay,
Struggling.
so $2,590.54 is what you want to have at your end balance in your allowance or doubtful accounts.
Okay.
But right now, I currently have a credit balance of $157.62.
Okay.
How do I get to this $2,590? $590.54.
You would subtract the two, and that amount goes in the bad debit expense.
Correct. Yes, because
Yay.
you already are on the credit side. How much more do you need to be to remember the allowance for doubtful accounts is a contra account. It has to have a credit balance at the end of the day. So in this
Okay.
case, because we're estimating how much we need to get rid of, this is what you need to know. That means this is your ending balance in your allowance for doubtful accounts. But how can you get there when you currently have a credit balance in your allowance for doubtful accounts? Because you're already on the right side, how many more do you need to go right? That is exactly correct. Okay? So what is the total amount? 2590.54 minus 157.62.
$2,432.92. 2432.92. Okay.
Yes. Okay, good. All right. So let's go ahead and practice that idea. So we're gonna go through more examples so then we can kind of get this. Okay.
Okay.
So the following problems are not related, obviously, to problems 1 through 6. Right. These are all separate. So
Okay.
if a company estimates that 20,000 of a 500,000 accounts receivable is to be uncollectible, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts. So how would you journalize this
So
adjustment?
this is gonna be the bad debt expense
Good.
and allowance for doubtful accounts, because we're doing the balance sheet method because it
Good.
says accounts receivable,
Good.
and then your bad debt expense for a debit is going to be 15,000.
Now you have a debit balance. You're on the left side now. How do you
Okay,
get to the right side?
so it'd be a credit of 15,000.
No. So right now, your allowance or doubtful accounts, you're on the left side. You have a debit balance. So remember, imagine a number line. Okay?
Okay,
If you're on the left side, 5,000 units, how do you get to 0?
okay, you go to the right 5,000 units.
Okay? Now you're at 0. How many more do you need to get to 20,000?
Okay. So it'd be 20,000.
Okay.
25,000.
25. Okay, plus the 5,000 from previous. Yes, so yes, you're at the end of the day you're at 25,000. So good.
25,000. Okay.
Yes, 25,000 is correct. Okay? So let's take another scenario. Question number um question number 8. Your company estimates that 20,000 of a 500,000 total credit sales is to be uncollectible, and there's currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
Okay, so this is going to be the other one, the income statement method.
correct.
Okay. And still going to be bad debt expense and allowance for doubtful accounts.
Because you have the choice between the two methods. Good.
Right. And then, okay, so total credit sales, credit balance of 5,000. So this would be 25,000 debit.
Okay, let's try again.
Okay.
So yes, you are correct in using the other method. Now, does the allowance for a doubtful account appear on the income statement?
I don't know.
It doesn't.
No, it
Okay.
doesn't. That's correct. So if it doesn't appear on the income statement, do you care about it?
No.
So
What
then
is it that doesn't appear?
the allowance for doubtful accounts, which is a contra account.
Oh, okay. Okay. I got you now.
Yeah, right? So in this case, right? It doesn't appear because a contra account is going to appear wherever the main account is, right? So in this case, if an accounts receivable
Okay.
will appear, so will the allowance for doubtful accounts. In this case, the income statement does not appear at all. All you see is just total credit sales. So do you care
Okay.
for whatever balance there is in the allowance for doubtful accounts?
No.
No. So your answer is going to be so if you don't care about whatever's in here, then what number do you care about?
Oh, the 20,000.
You only care about the 20,000.
Okay.
Mm-hmm. So another situation here, if a company estimates that 20,000 of a 500,000 total credit sales is to be uncollectible, and now this time there's currently a debit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
Okay. So we still don't care about that. So it would be 20,000 again,
correct.
but as a credit in this time. No?
What do you mean? What do you mean as a credit? No. They're all gonna be. It's all gonna be debited and credited.
All gonna be debit. Okay.
Yeah, all debited and credited. It doesn't matter because we don't care about
The
whatever's
other
in the
part.
allowance for doubtful accounts. All we care about is the estimated amount.
Okay.
So then let's try it again. If a company estimates that 20,000 of 500,000 accounts receivable is to be uncollectible, and this time there's currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
Okay. So we're back to the first one. Balance sheet.
Yes.
So it's a credit balance, and you want to go back to the right, right?
We
So
we
it'd be-
we are on the right now, so you
right. So
still
you want to go to
want
the left. Sorry.
no.
No.
Your
Okay.
allowance for doubtful accounts will always hold a credit balance.
Okay.
Okay, so we need to be credit for $20,000.
Okay. So $15,000.
Yes, I'm already on the right 5,000. So how do I get to 20,000? I need
Okay.
now it's 15,000. Good.
Okay. I think I'm getting it.
Awesome. Don't worry, we have plenty of time. There is a chapter 9 and 10 review. Okay, plus we got the study guide. So you'll definitely have plenty of time to go over this more and more times, okay? So
Okay.
any questions in regards to chapter 10.1?
Don't think so.
Okay.